afternoon, folks. I hope you've had a good week and welcome to our latest edition of the weekly wrap. We've just finished seeing the US president give his briefing on television. So now let's listen to the Hexagon's briefing, right, Hiloni?
Yes.
Over to you.
So, since the war has begun, India has corrected the most, with large cap correcting 8.1% and small and mid cap correcting less than the large cap at 6.4 and 7.4% respectively. An outlier here in terms of global markets was China, which has fallen the least at 1.4%. Emerging markets, as we all know, have been affected and it has fallen 7.4%. US, which is the S&P 500, has fallen 3%.
So last week when we were speaking, and I told you all that India has not fallen as much as some of the other countries. Looks like this week it has caught up,
Yeah.
and now we are as much or a little more than some of the other countries. So EM as a whole is down by 9%
Yes.
since the war began, and they, I guess, are the worst hit, followed by Japan,
Yeah.
which is almost 7% down since the war began. And these are obviously the vulnerable geographies because the EM and Japan imports most of its energy, and given what's happening to the Middle East, yeah, I guess the vulnerability is really coming out.
But isn't it surprising that even gold has corrected?
Yeah, it's quite unusual. One would expect that with the war raging on, gold should have gone up and silver should have gone up. But actually, gold has been falling since the war began, almost 6% down since the conflict began. So I guess that is because this conflict was already priced in. We've seen the last 2 months of rally, correct? And it's been going parabolic as we kept telling you all the while. And since the event has actually happened, the people are booking profits. That is one view. Okay. It can also be that since the war has begun, the US dollar itself has gone through a yo-yo. First, it strengthened, okay, and the US treasuries yields came down, prices went up, and yields came down, and then they reversed. As the scale of the problem became more evident, things changed. So you do see that the dollar index has gone up, but also the the US treasury yields have gone up. So it yo-yoed from 4.01 or so, 4.1, went down to 3.9 when I was very, very surprised. I said, is there a crisis coming along? Remember when the US treasury touched 3.9, and the crisis did come along, and it was first the private credit and then the conflict with Iran, and that is when the US treasury prices started falling and the yield became better and better, and now it's almost 4.2%. So when you have a safe 4.2% return coming in from a US treasury, the demand or the attraction of gold reduces. Gold does not give you any incomes. Let's go back to fundamentals. No income, no dividend. It just sits there. It's a block of metal sitting there on your table. And given that the US treasury yields are looking more attractive, investors are preferring to sell their gold and buy US treasury. Okay. And January saw the highest inflows into gold ETFs in India at more than 20,000 crores. Immediately the following month, it is the lowest, just about 5,000. So that was a lot of herd mentality, a lot of FOMO happening, I guess. People rushed into it, and typically, as it happens with the retail investor, it was the wrong moment when they rushed it.
They rushed at the peak.
They rushed at the absolute peak. And see what has happened. Okay, one needs to be very careful. Yeah, go on.
Yeah, so you were telling me that there was an interesting article in ET Wealth on fund manager ranking. So shall we dive into that?
Oh yes. So the ET Wealth this week has an article, a bit of research by Sanket Dhanorkar, and this is about the top fund managers of the country. So ET Wealth has published with their research who are the top 10 fund managers in the country. And while going through it, a lot of interesting stuff has come out, right?
Yes.
Some convergences and some divergences, isn't it? And one thing that struck out, you have 10 fund managers, okay, and the volatility range, all these are the top guys, but the range of volatility has been amazing.
Yes. So for a flexi cap, what we saw, the range of standard deviation is around 19 to 24. And even for small and mid cap, it's 27 to 28. But still, they managed to be in the top 10, even with that volatility.
Correct. So the risk-adjusted returns were good.
Correct.
But I'm saying just the top 10 guys in the flexi cap space, you had low volatility and such a high volatility.
Yes.
It's not that they were all doing the same thing.
Of course, yeah.
In fact, the one thing that struck us while we were reading this is that they're all doing different things
Yeah.
to be in the top, isn't it?
Yeah.
So tell us about how different it is.
Yes. So, to take an example, we all know Parag Parikh Flexi Cap Fund, which has been our core holding as well. So, Rajiv Thakkar, who is the fund manager, takes, good bets on being cash call. And they have amongst the highest cash calls in the mutual fund industry from time to time. We have seen this again and again in the fund. So, that also helps their downside protection. And they're able to comfortably sit on cash and deploy when the markets are falling. Against which we have Sailesh from Nippon, who is not allowed to take cash calls in his portfolio and who doesn't have the mandate for it. But what he has done is taken a lesser active share in his portfolio and manage his downside risk.
Okay.
So that's another way of managing your downside risk and managing your portfolio.
So you have one top manager who doesn't mind taking cash calls, and you have another top manager who does not take cash calls, and both have remained in the top 10.
Yeah.
Okay. And what is meant by a lower active share?
So that means that you don't have much divergence from the index.
Yes, that's right. So he prefers to stick to index allocations rather than move away from index allocations. So he's sort of hugging the index and okay, whatever the market does, I will also do.
Correct.
I will not take on additional risk is what he seems to say. So
yes.
You have and then you also have people like Dinesh Balachandran, okay, who takes tactical views,
Yes.
okay, who's a contra player,
Yeah.
is it not? Versus somebody who's a momentum oriented player,
Yeah.
and that also makes a lot of difference. So you have, within the top 10 you have multiple styles. You have value players, you have growth players, you have contra players, you have small and mid cap players. And I think it just goes to show that a well constructed portfolio should and can have different styles
Yes.
and different approaches, and that is how you get a great portfolio, isn't it?
Yeah.
Views of these people are quite different also. So some of them expect earnings to be slow, some expect earnings to be recovering, some think it is cheap, some think it is expensive, and based on this they have all been managing different strategies.
Some of them are favoring value stocks right now. Some of them are chasing counter-cyclical stocks. Some of them are positive on domestic cyclical stocks, and some of them are also positive on growth names. And they're picking up those stocks as we move forward in this environment.
Yeah, I think that's fun. So we have the number one, Mittul Kalabadi of iPro. He says valuations remain high, so expect further price or time corrections in the market. Okay, and while Rajiv Thakkar says that while overall the market is still trading at slightly above average valuations, earnings growth is improving and one can reasonably expect equities to deliver low double-digit returns over the medium to long term. Okay, so I think what he wants us to also note is that low double-digit, he's moderating expectations. That's not to be looking at that 15 to 20% range of returns, but maybe in the 10 to 15 or even 10 to 12 or 13% kind of range. He may be saying that, right? When he says low double-digit. So we have to take note of that. And we have Dinesh Balachandran who says, with price and time corrections, valuations now appear more reasonable. Okay. On the earnings front too, most downgrades seem to be behind us. So there's some optimism coming in from these gentlemen. Shankar Naren says, our outlook is slightly more positive than last year, though Indian equities remain expensive on valuations. Asset allocation remains the best way to approach investing. I think we completely identify with this board, saying that asset allocation is the way to go, and that way we are textbook players.
Yeah.
Right, over the last whatever 25 years that we've been doing this, we've been sticking to a regimen on asset allocation, and that is very, very helpful. Okay, and Manish Gunwani, what does he say? He says the risk reward has improved materially as both stock prices and the currency have corrected. Yes, so the currency has corrected a hell of a lot.
Yeah.
So how much has our currency fallen? So okay, so we thought we were recovering, and then we've gone back to almost 92 rupees.
Yeah.
Is it not?
Again, yeah.
As the price of oil has been moving up, and Iran says prepare for $200 a barrel.
Yeah.
So I guess our currencies are going to be scared. Whoever is importing oil are going to be on shaky legs.
Yeah.
Is it not? I don't think we can expect any immediate strength in the currency as long as the war is going on. And then we have Aditya Khemani, who says the economy saw gradual cyclical weakness over the past 18 months, leading to broader market softness and a cleanup of excesses. I think that is something again we agree with.
Yeah.
That a lot of froth has gone out, and at times in the small and mid cap space we don't see it. We think the index is holding up, but actually within the index we have a large number of stocks that have fallen more than 20%.
Yeah.
Right?
Even more than 40. That's something that we did a couple of weeks back where we saw how much that's fallen. I'm sure it has fallen more than that now.
Yes. So that is what this gentleman means to say when a lot of froth is gone up and a cleanup has happened.
Yeah.
Which makes it a good time to slowly get back into the market. And whereas Sailesh Rajban says earnings muted over the past 2 years are beginning to revive, which is good news. So you have some people who are optimistic, some who are cautiously optimistic, to have a term. I don't see any pessimism. Is it not? I think the most pessimistic maybe might have been Shankar Narain, who says equities remain expensive on valuation. Yeah. Right, he's the one, and that's why he says asset allocation is a key to monitoring and progressing with your portfolio.
Even Chirag from HDFC says that due to geopolitical risks, US growth concerns, and AI-driven excesses may cause intermittent volatility.
Okay. I think we should be very cautious. But there's one more thing I think we should take note of. How was last year's? What did last year's top fund manager review say?
Yeah.
All right.
Yeah, but yeah.
So yeah, I have the sheet with me. So the same ET Wealth top fund managers of last year, quite different. Out of the 10 that were listed last year, 5 are out.
Wow, 50%.
You can toss a coin.
So the churn was 50% there.
Yeah. So much for these lists which give rankings. They do give you a perspective. They give you data. But if you are wanting to chase fund managers using this list, I don't think you're really going to be there. You can still toss a coin and be where you are. Is it not? Of course, your universe is a little smaller.
Yes.
I mean, instead of the hundreds of managers, you're probably looking at a set of 10 or 20 managers and tossing a coin at them. Yeah. I think people like the PPFA's Rajiv Thakkar, who was number 1 last year, is now number 2.
Yeah.
Then you have Dinesh Balachandran, SBI, he's remained number 3. He hasn't given up his position, which is a good thing. And I think the significant move up was Mitul Paipru, who was number 7 and is number 1 this year. Why do you think? How do you think he managed that?
I think his contrarian style of managing the fund and taking counter-cyclical bets have helped him in such a last year, the market that it has been. So I think that would have helped him. Again, looking at the funds that he managed, he did not have a lot of leeway. They have IPRO dividend yield equity that he manages. You have ELSS that he manages, but he's focused equity. But he was still able to create impact over there, and a large impact, clearly.
So I think when you had a market which was falling, contrarian calls helped a lot.
Yes.
So again, good to have a bit of everything in your portfolio, I guess.
Yes, the same was with Dinesh, who manages SBI Contra Fund as well.
He's also contrarian.
Yeah.
So again, the contrarians won
Yeah.
last year.
Yeah. Really.
All right. Great.
In this kind of market, what do you think one should do after reading all these perspectives? Should one take any action or should one stay still? What's your thought on it?
It's interesting options that you put down. Should one stay still or do something? So it's a human bias to do something.
Yeah.
We think action is good, but action is not always productive.
Hmm.
You don't need to act. There's no compulsion to act. One should accept the fact that if your decisions have been right, if your asset allocation has been right, there's no need to do anything about it. I mean, any advisor would have told you that market do go up and down, and we've had such a great bull rally. Something is bound to come and hit you. I mean, it could have been a war, it could have been inflation, it could have been anything. It could have been an asteroid. Correct? Something can come and hit you. We don't know what. But after a very good rally, expect something to happen. And when it happens, don't panic. Knee-jerk reactions are out. Okay, you can just stay put.
Okay.
All right, and given a year or year and a half, things would recover. But on the other hand, like any of the gatherings or parties that I have been going to, the central point of discussion is the war. Okay, and everybody and anybody with a drink in their hands are giving out opinions as to which direction the war would proceed and how long it would go and when it would end, etc., etc. I only asked them one question: do you know what Trump is thinking? Do you know what Khamenei is thinking? Do you know what Netanyahu is thinking, or what is his strategy? No. If you don't know what they're thinking, how can you even predict? These things are beyond our control. Isn't it?
Yeah.
We can only control our actions. We cannot control, we have no control over others' actions, leave alone these maniacs out there who are supposed to be leaders. Okay. So in such a case, what do? Don't say buy, don't say sell. I say just rebalance. What do you think?
I agree. One more question that comes to my mind: if somebody has liquidity, do you think it's the right time to enter the market or to deploy some of the liquidity that has been lying around into the equities?
Yeah. So I think there are two ways of looking at this, Hiloni. If you find something that is valuable at this price, okay, I don't think we should try to put an end date as to when the war will get over, when will the market recover. But if you found something that is good to buy with the attitude that someday it will recover. But at least your downside is covered. You bought something that is valuable.
Of course.
The same price was not available a few months back.
Agree.
Okay, and that price is available now. Buy it and hold it. That is one way. The other way is, if you do have liquidity, gradually move in, do a long-term STP, and if there's a little bit of panic, add a couple more installments into the pot of equity and go on. But I think whether to buy equity or not is still an asset allocation decision. If you do not have an asset allocation on paper and in practice, then it's the Wild West. One cannot say anything about the outcome and whether you will be happy with the outcome.
So for a long-term investor, it's a time to go shopping.
Definitely. Definitely time to go shopping, Hiloni.
Yeah.
Okay. And you can't plan in the last minute.
Of
You
course.
need to have your plan ready now and execute as the time becomes better and better to execute the plan.
Yeah.
And my friends, we are going to slightly morph the way we do things, and we will be having a larger umbrella under which we do these podcasts. It is called the Aware Investor. Okay, and under this umbrella, we will be reaching out to you with different topics and different perspectives, and we'd love to have your questions also. Okay, instead of listening to us all the time. Okay.
Yeah.
Good day. Have a great weekend.